Okay, so this is the lecture on asset pricing. Today we are going to discuss about stock market seasonalities. Okay. I will cover 4 articles, including Heston Sadka 2008, published in Journal of Financial Economics. Second article is Keloharju, Linnainmaa, Nyberg, published in 2016 Journal of Finance. I will also briefly review the paper published in JFE 2018 by Justin Birru. And finally, I spend most of the time talking about Hirschleifer-Jiang and Meng, my article published in 2020 at Journal of Financial Economics. So the first part, I'll talk about what do we know about return seasonalities, a review from the perspective of investor mood, because that's the idea of our article. So that's the lens through which I will review the existing research. Okay, so let's start with the day of the week and the relationship with respect to investor mood. So how investor mood changes across days of the week. Survey studies back in the 70s and 80s have shown that people tend to be happier towards the end of the week, such as Friday, but less happy towards the beginning of the week, such as Monday. So this has been shown by using survey studies based on college students in the US and based on general populations. The recent research published by Justin Birru, and he looked at the investor fear index, which is the VIX index, as well as the text mining messages from the Twitter to infer the sentiment of the investors. Those confirm that investors tend to be happier on Fridays and less happy on Mondays. Okay, and in another study done by myself and my co-authors, we also find that the Gallup, which is the daily survey index of US mood, also shows a similar idea. So basically, this is what you can see by Google image day of the week or weekday. You will see that this for an average person, the mood tends to be low at the beginning of the week and tends to elevate towards the end of the week. On Friday, people were happier because they anticipate a break from the daily routine. So when it comes to stock markets or financial markets, that day of the week effect also reflects in aggregate stock returns. And the research dates back to 1980s, done by French, as well as Smith. And they show that stock returns at aggregate shows seasonalities across days of the week. Okay, so this is the regional research results, the yellow one. The yellow bar shows the regional research results from Lakonishak and Smith. And the blue bar shows my replication using the equal weighted CRISP index, market index data. As you can see that on Mondays, we tend to have the worst average return relative to other days of the week, but on Fridays, we tend to have better or the best return relative to other days of the week. So when people are more depressed, stock returns tend to be lower. When people are happier, stock returns tend to be higher. Okay, so stock returns appear to be positively related to investor mood at the aggregate level across days of the week. Keloharju, Linnainmaa, and Nyberg research, which we discussed, shows that across the day of the week, there is a persistence in stock returns that occur on the same day of the week. Okay, if you run the Fama-Macbeth regression of the cross-sectional returns of individual stocks on its lagged returns, okay, lagged by K, right? So K can be anywhere from 1, lagged by 1 day, all the way to 5, 10 to 125 days, which corresponds to about 6 months, lagged 6 months of daily returns. You will see that the coefficient estimate, which is BT here, shows a very prominent pattern with the peaks at the five-day intervals. So we see a peak at 10-day, at 15-day lag, 20-day lag, 25-day lag, and so on and so forth. That persists for at least 6 months down the road. Okay, so this shows that stocks that do well on certain day of the week tend to have the similar relative outperformance on the same day of the week for at least 6 months down the road. Okay, so we call this phenomenon the same weekday return persistence effect. So the next study related to day of the week effect is from Justin Birru 2018 JFE article. So what he shows is that if you look at the long-short strategies, long-short portfolios formed based on different characteristics, and you will see a contrasting pattern of the long-short portfolio returns between Monday and Friday and across day of the week. Okay, so taking one of the characteristics he researched, idiosyncratic volatility, as an example. Okay, so the traditional arbitrage portfolio, to arbitrage the low risk anomaly, is to long low volatility stocks and short high idiosyncratic volatility stocks. So this long-short portfolio, on average, unconditionally will outperform. However, Birru finds that this portfolio performs the best on Mondays and Tuesdays, then gradually recedes. If you go to Friday, this portfolio actually loses money, right? So the idea is, if you want to do a long-short portfolio that's arbitrage, a low-risk anomaly, and it performs really well at the beginning of the week, but not so much at the end of the week. And in fact, across a lot of different portfolios, Birru shows that the long-short strategy, that long, less speculative stocks and short speculative stocks tend to do well at the beginning of the week, like the idiosyncratic volatility long-short strategy. But the other strategies that look at long speculative stocks and short non-speculative stocks will tend to actually do better on Fridays or towards the end of the week. Okay, so in general, when people are in elevated or upbeat mood, they tend to purchase speculative stocks relative to non-speculative stocks. Those strategies that long speculative stock will tend to do better on Fridays and vice versa for Monday. Okay, so this is another piece of existing research that's showing long-short strategies shows a return patterns that's consistent with higher investor mood on Fridays and lower investor mood on Mondays. So that's my review for the day of the week, seasonality, and the investor mood. Okay, so next, I want to go to review the seasonality effect in investor mood as well as in financial markets across months of the year, across calendar months throughout the year. Okay. So previous research has shown that investors tend to be more optimistic in January and March. Okay. For instance, a lot of research has shown this January effect, right? In January, stocks tend to outperform, especially in the beginning of January, especially for small stocks. And another article I did with my former PhD student, Bergsman and Zhang, we showed that stocks outperform not just in January 1st, but in New Year. In some countries, when New Year differs from January 1st, you actually see the outperform stocks in New Year month, not necessarily in January. This has been the case for China stock market for sure. Okay, another study, Kemstra, Kramer, Levy, and Werners, 2017, they found some very interesting patterns showing that March is associated with higher or improving investor mood because it's associated with the least onset of the seasonal affective syndrome, which I'm going to talk about, right? So, and that's evidence people have shown and find the link between a calendar month and investor mood. Moving to September and October, and there's evidence showing that those 2 months are associated with investor pessimism. So investors tend to have downbeat mood when moving to September and October, right? The main study I'm going to cite here and demonstrate in my next slide is again by Kemstra, Kramer, and Levy, but it's a paper in 2003, and they talk about that seasonal affective disorder tend to occur following the autumn equinox, which is in September for Northern Hemisphere markets, because that's when the daylight hours start to shorten. When people have exposure to less sunshine and less daylight, and depression starts to take off, right? So the idea of this review shows that variation in investor mood is systematically correlated with calendar months, okay, across seasons. So this is the chart from Kemstra et al.'s paper in 2017. I remember it's published in JFQA. So what they are showing here is an onset recovery variable. So something you can think as a net change, net increase in the proportion of seasonal depression affected, SAD affected individuals actively suffering from depression. So when this number, all 3 measures, when they are high, right? So this one with the little circle, it's the daylight hours, right? So when the measures are high, a lot of people are suffering from depression. And when the measure is low, less people are suffering from seasonal depression. And you can see that in March, there's a trough. But from September to October, we have a peak. So people tend to have upbeat mood here, high mood here, but low mood or downbeat mood around September to October. Consistent with the explanation of the SAD effect, right? Investor mood or depression. And the authors showed that net flows to riskier or less risky market is also consistent with the pattern, right? So what you see here at the peak in March is actually the flow to, if I remember, it's the flow to equity. So and the here at the bottom is the flow to government bond. So riskier assets have a lot of cash inflow, meaning a lot of investors put money into riskier assets around March, but a lot investors pull money out of less risky assets such as government bonds to invest in risky assets. Okay, but in September to October, you see the opposite pattern. People are risk off. They want to put more money into the government bond, less risky assets, and pour money out of the risky assets such as equity. Okay, so that's consistent with high mood in March and low mood in September to October story. At the aggregate level, we see a similar pattern in stock returns, right? So this is, again, my replication of the Lacani-Smith by using equal-weighted CRISP return, and they have done the study for Dow Jones Industrial Average for 1897 to 1986. But the patterns are consistent, showing that in January and March, if you focus on the equal-weighted returns, and January has the best performance, March has the second best performance, but they are overall quite strong. And September, October, we tend to have the worst performance on average in historical data. Right, so that's consistent with higher mood in January, March, and lower mood in September, October. Right. And the study done by Heston and Sadka shows the same month's return persistence, right? So this is something we discussed, and showing that if you run a Feynman-Macbeth regression of stock returns regressed on their lagged stock returns, and you can choose the lag from anywhere between 1 month to 240 months, which is 20 years down the road, and you will see that the predicted power, the coefficient, peaked at the intervals of 12, right? So which means that stocks that tend to do well in a given calendar months will tend to repeat that relative performance year after year for at least 20 months down the road. So we call this phenomenon the same month return persistence effect, right? So those are our review of the day of the week and the calendar months level return seasonality, and how's that possible link to investor mood. But now we want to formalize that hypothesis based on investor mood to understand stock return seasonalities. So that comes down to our article, Hirschleifer, Zhang, and Mount 2020, and we proposed a theory based on investor mood. So our key innovation of the paper is to show, based on the premise that investor moods tend to vary across weekdays and calendar time in a predictable way. So therefore, we can use the stock return behaviors during the high or low mood seasons to capture the sensitivity of a stock with respect to investor mood. Then we can use that sensitivity to predict what the stock is going to behave under the future predictable investor mood state, right? So in our test or our hypothesis, we assume that Friday have high mood, Monday have low mood, January, March have high mood, and September, October have investor have low mood because of the evidence we have reviewed. Okay, so that's our intention or goal for this particular article. We will try to develop something we call mood beta to capture that seasonal sensitivity of stock returns with respect to mood. Right. We have reviewed that seasonalities has been documented in the time series and in the cross-section, which is all the slides that have covered, and show you how much we have known about seasonality, but we do not have a systematic research on how those seasonality in both the time series and cross-section are related to a hypothesis related to investor mood, right? So our research starts with a factor model, but at the end, this model wasn't published together with the article, but it was our sort of thought framework to derive the hypothesis. Okay, so in our model, we have a factor, individual stocks payoff is derived from 2 factors in addition to a constant term with an error term, right? So the first factor is our hard to value factor. It's subject to investor mood inference. And the second factor is the easy to value factor. It's not subject to mood inference. So when mood changes, it's going to affect the perception of F1, but it's not going to affect the perception of F2, right? So we have mood-prone, risk-neutral investors, so we don't worry about risk premium in the model, and we have signals sending to investors about each factor. Investors would perceive the signal with the length that's dictated by mood, right? So when they are in good mood, they tend to perceive the signal as being too optimistic relative to the truth. When they are under bad mood or low mood, they would perceive the signal with too pessimistic length, right? So that's a bias imposed on the perceived signals, right? So the idea is, suppose we have two stocks. One is a multinational, the other is a domestic stock. And suppose the first factor is a foreign market growth factor. The second factor is domestic market growth factor. And so the first factor is harder to value. It's more subject to the mood inference. And so our stock A would have high beta, high loadings on the first factor, low loadings on the second factor. Then we assume that both beta 2 are the same for those companies. Right. So what's going to happen is, if investors are in high mood, then they would perceive the signals about foreign sales with an optimistic length, right? They will become too optimistic about factor 1. Therefore, A will become overpriced relative to B, and A will be earning higher rate of return at this point relative to B, right? When this mispricing occurred, and that's why you see A has a big bump in stock returns and become more overvalued than stock B. In contrast, when people are in bad mood, they will become too pessimistic about foreign sales. And during that period, you will see A underperforms B, and market overall will also underperform, right? So this tells you, if you can predict how investors behave or investors' mood changes in a given state, you know what's the relative performance of A versus B, because you can identify A versus B in their historical performance under the similar mood impact. So our goal, in addition to do forecast based on historical seasonal returns, we also want to develop a new measure called the mood beta, right? So the mood beta will, according to our proof, it will end up equal to beta 1 in this case. It will measure the sensitivity of a stock's seasonal returns with respect to aggregate seasonal return, right, induced by mood swings. So you can see that in this case, the mood beta will be high for A, then for B, because the correlation between A and the market will be much higher than B during the mood sensitive, the strong mood seasons. Okay. So our empirical predictions will include two parts. The first part, we have prediction regarding the cross-sectional returns. So we predict that the cross-sectional returns will recurs during congruent mood states. So basically, high mood to high mood, that's congruent. Low mood to low mood, that's congruent. But high mood to low mood, that would be non-congruent. In that case, we predict stock returns will tend to reverse, right? So how do we identify high versus low mood? Going back to our previous discussion, we'll use calendar months and weekdays that has been identified associated with high versus low mood. But the second part of the test of our research is related to the concept of mood beta. So we're going to construct a mood beta to capture sensitivity of stock returns with respect to investor mood measured by aggregate stock returns, we predict that mood beta will be positively related to expected returns during the good mood state, but negatively related to expected stock returns during the bad mood state. Okay, so that's our hypothesis. So next part is to review our empirical test. We're going to first focus on the seasonal return, reoccurrence, recurrence, and reversal effect, right? Same mood, reoccurrence. Opposite mood, reversal. That's our prediction, right? So we used 1963 to 2016 data, and we identify positive and negative mood according to two methods. One is the historical average return, which corresponds to the to Friday, January, March we have discussed, or Monday, September, October related to low mood, as we have discussed. The second one is to use the realized past return of the aggregate market in the past week or years. High will be associated with high mood, low return will be associated with low mood, right? So the idea is mood varies predictably across seasons, and that's also supported by previous psychological research. Okay, our test assets have three. One is the full set of individual securities traded in the major exchanges. The second is the 94 Baker and Wergler portfolios, and the third one is the 79 Keloharju et al. Portfolios, which you have seen in many of the charts. Okay, so our first test is to see whether return recurs across the congruent mood weekdays, right? So for Monday to Monday, low mood, do you see return relative performance reoccur? Friday to Friday, do you see relative performance reoccur? And that's basically replication of Linnainmaa, Keloharju Linnainmaa's Nyberg's results that focus only on 2 days of the week, not every day. So this is essentially what we find, right? If you look at high mood weekday, which is Friday, and if you look at the 20% stocks, this is their average return. If you look at the bottom 20% of the stock, this is their average return, right? So if you can identify the top 20% stock that do well on Fridays in the past, they continue to do well on Fridays now and in the future, right? So this is the return reoccurrence for high mood. This is also return reoccurrence for low mood, right? As long as you go from the same mood to the same mood weekday, you see the recurrence of the relative performance. Okay, on low mood weekday, which is Monday, all stocks don't do well, but the top 20 stocks that did well in the past Monday continue to do better relative to those bottom 20% stocks. Okay. How about moving from Monday to Friday and Friday to Monday? When mood is predicted to predictably shifting in the opposite way, right? So this is what we call the non-congruent mood weekdays, right? So we predict that the relative performance will reverse, right? Historically, well, better performed security will underperform, right? So if you look at the 20% the stock that did well in the previous high mood state, they now will underperform, right? So now their return is lower than the bottom 20% of the stock that historically underperformed. So you see this reversal effect for both high and low mood weekday. When you switch, when you look at the predictability moving from the opposite mood state to high and opposite mood state to low. And that's why you see this relative underperformance. That's a reversal relative to historical performance. Okay. Going to month, right? monthly patterns, calendar month patterns. We select January and March to be high mood month, September, October to be low mood months. You see the return recurrence effect if we look at the states across congruent mood month, right? You see that relative performance persists, right? Stocks that do well in the past January, March, they continue to do well in the current January and March, right? And similarly for September, October. But if you move from high to low mood state or low to high, you have the non-congruent mood months. You see that stocks that did well in the past tend to underperform now in the opposite mood state. It applies to both high versus low mood months for current month. Okay. So the idea of those results are showing that we have the return recurrence effect if we compare congruent mood state, right, from good to good or bad to bad. We see that persistence, recurrence of relative performance. But if we move from good to bad and bad to good, we see the reversal effect for the relative performance. I apologize for this little symbol here. Okay. So our second test is related to mood beta. Right? We have shown that if you look at historical returns, they actually help you to predict the future relative performance under good or bad mood state, under congruent and non-congruent mood state. But we want to capture that effect using something related to aggregate mood fluctuation. We call it mood beta, right? So mood beta capture the sensitivity of an individual asset return with respect to the investor mood fluctuation. And we think that one can help us to capture this reversal and recurrence effect. Right? So the mood beta is estimated at using two approaches. We can either use monthly return, we can use weekly return. So it's simply a one-factor model, but the only difference is there are two differences. One is we're not using the value-weighted market index. We're using the equal-weighted market index because we believe that small firms will be more subject to the influence of investor mood. So we don't want to miss that, right? So this is the first difference between our model and the typical single factor model. The second difference, which is crucial, is we're not using all the historical months return. We're not using past 36 months, past 50 months. Instead, we're using the past mood months return over the most recent 10 years, right? So every year, if we have January, March, September, October, that's all the 4 months we use. Then we take all the 4 months in the past 10 years. Of course, we have, in addition to the calendar months, we have months that's determined by historical realized aggregate, equal-weighted aggregate returns, okay? And so that's the difference. We are taking only the high or low mood months to run the regression. We can do the same regression using daily return, but we're taking not all weekday returns. We're taking only Monday and Friday returns over the last 6 months to come up with the estimates of the beta, which we call mood beta. Because we believe during those periods, the beta estimate will reflect more sensitivity with respect to mood as opposed to with respect to fundamentals. Okay, that's our premise. It may not work, but we can see what the data says. So the composite mood beta is for the first principal component of the two, those estimated from monthly returns versus those estimated from weekly returns, weekday returns. Okay, so we take the mood beta and estimate it for portfolios. As you can see from the portfolios, and you can read the article, we show that it's really consistent with a lot of our prior, that very hard to value, hard to arbitrage portfolios tend to have higher mood beta. They're more sensitive to fluctuation in investor mood. For instance, companies that have no dividend, right? Companies that have high volatility, companies that have zero earnings. They're difficult value, difficult arbitrage. They tend to have high mood beta. So when mood is high, they tend to earn high returns. When mood is low, they will tend to earn low returns. That's exactly what we find, right? If we look at mood beta stocks that's high versus low, when the current mood is high, and the high mood beta stocks will tend to outperform. But when the current mood is low, the high mood beta stocks will tend to underperform. So once you can figure out which stock have high mood beta, which stock have low mood beta, you pretty much know what's their average performance when the mood will change to a different state or some same state. Okay. We also look at the month level, right? So you see the same pattern. You see that using mood beta, high mood beta do well in high mood months and do worse in low mood months. Right? So that's exactly a similar pattern that we have documented for reversal and recurrence effect. But there you have to identify their relative performance using historical realized returns. Here we're using estimated mood beta, right? So that's what we find. So lastly, we look at the predictability of mood beta going beyond the testing setting in regular calendar months or weekday stock returns. So this is a very strong cross-domain test that will give hopefully establish validity of the mood beta. So we look at 3 settings, but unfortunately those 3 settings have not been published because our paper was too long. So we had to shorten the paper and leave this part of test for future publication. So the first test is to look at pre-holiday settings, right? So historically, pre-holiday trading days, the 1 to 2 trading days prior to major holidays like New Year's Day, Valentine's Day, President's Day, and so on and so forth in the United States, the stock market tend to do well, right? For the day or 2 before major holidays. Right? So that's called pre-holiday effect. So what we find is when we have pre-holiday effect, that's when people are happier, when people have high mood, and the high mood beta stocks do better than low mood beta stocks. Right? So this is our long high minus low returns. You see it's very positive for all 3 sets of test assets during the pre-holiday trading days, but not so much in other trading days. The second setting we test mood beta is to look at the daylight saving time changes. Right? So the paper by Kamstra, Kramer, and Levy 2000, they hypothesized that investors are subject to the SAD effect and also during the spring and fall daylight saving time changes. Right? So when you have sleep disruption because your clock has to change back and forth, right? And it caused a depression, right? Temporary depression on investors, that stock returns tend to be low on those days, right? Following the clock change on the Monday, stock returns tend to be low, right? Doesn't matter how you measure that using value-weighted or equal-weighted returns. And we show that this is the case in our sample using updated sample. But what's most important is that over the weekend, when we have the clock change due to daylight saving times change, and high mood beta stocks tend to underperform. So high minus low return will be really, really bad, really, really low for those weekends relative to other weekends. So when people have this strong depression and low mood state, you see a huge negative high minus low returns based on mood beta. So that's exactly what we predict based on the theory, right? So the last one is the weather-induced investor mood change, right? So in the past, we have seen a lot of studies like Hirschleifer, Shamway, or also Sanders, 1993. They show that stock returns tend to be higher when It is a sunny day on in the city where the major stock exchange are located, right? So this is New York City. So we're using New York City data, weather data. We first replicate those research showing that on sunny days, we do have higher stock return, aggregate stock returns than on cloudy days, right? So the sunny days, cloudy days, everything in between, you can see that stocks do outperform on average under sunny days of New York City, right? So this is what people have found and we replicated. But what's new here is that we show that the high minus low mood beta portfolio do really well on sunny days, right? When people are happier, high mood beta return stocks will outperform, but they underperform on cloudy days, right? So that's exactly what we predict. If you can predict how mood will change, you can predict how relative returns will occur. So taken together, our research intends to provide a unified framework based on investor mood to explain both the aggregate and cross-sectional return seasonalities, and both the monthly and daily seasonalities. Will provide new evidence showing there's a cross-sectional return recurrence, which people have found. There's also cross-sectional return reversal across month, across weekdays, across market states. And finally, we'll propose a new measure called mood beta, which can forecast cross-sectional return performance based on the predictable high or unpredictable high versus low mood state, right? High mood beta stocks tend to do well under high mood state and do worse under low mood state. So that's our research.